go to Art Laffer, a former Reagan economist, and Svengali, probably one of the most instrumental economists in American history. Of course, I just read that from the resume he gave me here. No, I'm kidding. Art, it's always good to have you. You know, Art, I always said, you know, I want to bounce this off Art. I don't remember any government spending initiative, the big spending initiative of any size or type, that ever reduced inflation, or for that matter, deficits and debt.
No, it can't. I mean, when you give people free money, Neil, they'll choose more leisure and there'll be less production of goods and services. That by itself is inflationary. And number two, it'll have to be funded and financed in the capital markets. And if the Fed is controlling interest rates, that means it'll expand the Fed's balance sheet, which it has done to almost $9 trillion number. And that, too, will provide more money and less goods, which is all pure inflation. It's too much money chasing too few goods. Increasing the amount of money and reducing the amount of goods is an inflationary strategy, period.
So here we are with the Federal Reserve all but saying all this must stop. And we've not been the better of it since Jerome Powell made those remarks last Friday in Jackson Hole. And we're still trying to dig out of that hole. Is it now time for the reality that he means what he says, and he says what he means?
Well, I think that's true. He does mean what he says, and I do think he's going to do it. But the way he should do it is just by removing the price controls on interest rates right now. Just let interest rates seek their own level, just the way Paul Volcker did in the late 70s and early 80s. We had interest rates when we came into office. I mean, the prime interest rate was 21.5%, but that was how he got control of inflation.
But he did raise rates so that he could control, right? He did raise rates that he could control. It had that effect of, you know, effective primary and all that other stuff, but he didn't come in there and stand back and watch it.
No, he just let interest rates go up and he reduced the monetary base simultaneously and thereby made very tight money, which is what you need to stop inflation. Right. And Reagan, by cutting tax rates, increased the supply of goods, and the two together brought inflation down like a stone, Neil. I mean, if you remember that time, we had mortgage rates 16, 17%.
I remember that.
I mean, you remember it. I know you were just a baby, but
did I ever tell you about what my wife and I paid for our first mortgage? Oh, I did, 50 times, I'm told. Art, but Art, let me ask you this. Yes. Now we've got this new spending going on. The administration says it's not going to be inflationary. This college loan relief is actually going to cut back on inflation. I'm just wondering how likely that is, because it's got to complicate the job of the Federal Reserve right now, no matter how you feel about those kids and who's behind on what loans and by how much. What do you think?
Yeah. Well, I don't care what type of economist you are, a Keynesian or a supply-sider, but if you look at it scientifically, and I think most of the Keynesians agree, that the giveaway there on the loans will increase inflation. That will increase inflation. The spending bills will increase inflation. They add to the monetary base, and they reduce the supply of goods and services, which is inflationary across the board. Where we disagree is how to solve it. And that's a huge difference between them, let's say Larry Summers, and me. That's the big difference. I want to cut tax rates and expand the supply of goods, and I want to release interest rates so the monetary base comes down. And they don't want to do that. They want to reduce demand. And by reducing demand, you can also reduce inflation, but that will lead to a recession, a slowdown. My solution will be like the Reagan solution, will lead to the boom of the 1980s as inflation collapses before our very eyes.
You know, Ro Khanna was here, the California congressman, a good man, don't get me wrong, but this notion that we are paying for this, Neil, because we've hacked away at the deficit and the debt. And all. The way I likened it is, wait a minute, you're paying that with an expanded credit line now, and that is in cash on hand, right?
Yeah, that's true. And, you know, it's the way they can formulate arguments is just beyond belief. When you look at it, what is the Fed's balance sheet? That is sort of the monetary base that underlies the inflation. And that's almost $9 trillion. I think it was 45 years ago, 6 years ago, it was in the billions, not trillions. So they have expanded the monetary base. And as you know, the economy has slowed down dramatically. Now, whether it's a recession or not, I mean, these guys will argue over how many angels dance on the head of a pin all day long. But the truth is we've got very slow growth, Neil. And we have not progressed since February of 2020. We've had a very slow economy, which means the supply of goods is short and the money is long, and that is inflationary, period. And that's what you're going to see. And I don't think next month's number is going to be big. But once we get by the oil sort of change, the spot commodity price change, I think you're going to see those inflation numbers coming back very substantially. I mean, shelter, which is just 1/3 of the index, has been just going straight up. I mean, that's a rental from your own self for your own home, as well as rents. And that number is not tapering off at all. So I think we've got an inflation problem for a long time to come. And they're not doing the right thing to solve it.
Art, thank you. I think wise words. Art Laffer, the former Reagan economist.